Chapter 5, Evidence and Documentation. Okay. Sufficiency of evidence. Evidence must be sufficient. Sufficient is a measure of the quantity of the audit evidence. Have we enough evidence to actually do a test? Greater risk of material misstatement requires a higher quantity. So the higher our risk level, the higher our quantity of evidence. Okay? Higher quality audit evidence results in a lower quantity. So if the quality of the evidence is high, then our quantity is lower. Okay? So the higher the misstatement, the risk of misstatement, the higher the quantity. The higher the quality, the lower the quantity. Okay? And appropriateness. So we have sufficiency and we have appropriateness. Okay? Appropriateness is relevance and reliability. Okay? Appropriateness is the measure of the quality of the audit evidence. So the higher the relevance, higher the reliability, the lower the quantity. Okay? So high quality is going to be, or high reliability is going to be independent sources of the evidence. Bank statements. We will give a higher quality to evidence that comes from outside of the company. Once we evaluate internal controls do not have any deficiencies, or deficiencies are very low and minimal, we can assign a higher quality level to the evidence that we're going to pull for substantive testing, which means the quantity will be lower. And our direct personal knowledge, okay, so our professional skepticism, we can assign a higher quality level based on that information and a lower quantity of evidence required. Documentary evidence. Every RBC that we have asked for, we've gotten, and it has been quality. We don't have any issues with integrity or anything like that. We can assign a higher level of quality and a lower level of quantity. And then, of course, original documents. They give us, when we ask for RBCs, which is required by client documentation, we get the original documents. These are not copies. We get original documents. We can assign a higher quality to this type of evidence and a lower quantity level. Okay. Evaluation of the evidence. Proper evaluation of evidence requires an understanding of the type of evidence that is available to us and the relative reliability of the available evidence. Okay. How reliable is the evidence that we're going to receive from the client? Okay. We should be able, an auditor should be thorough in searching for evidence and unbiased in its evaluation. Remember objectivity, okay, which is part of our second general standard. Okay, you've got to be objective. Okay, our audit procedures. Okay, specific acts performed by the auditor to gather evidence about whether specific assertions are being met. The risk assessment procedures, test of the controls, and substantive testing. Okay, you've seen that a few times now. Okay, set of audit procedures prepared to test assertions for a component of the financial statements is referred to as an audit program. Okay, so the audit program for accounts receivable. Okay, so we have management assertions, and then examples of audit procedures. We have existence, we have rights and obligations, completeness, valuation or allocation, presentation and disclosure. Okay, so for existence, we confirm that the receivable is actually there. Existence. Okay, if the receivable has been sold or pledged to somebody, do we have a right to this? Completeness. Okay, agree, control an account with the total of subsidiary accounts. Remember the major accounts and then all the accounts under there. Like we'll have account number 201, then we'll have 201 TAC 2, and then we have 201 TAC 3 that make up 201. So we will look at all of those. Select shipping documents immediately prior to year. Remember, prior to year end. Remember, we were talking about in that last quarter, we may have things that don't actually get recorded because they would adversely affect the assertion or the bottom line, because we don't want this giant expense, or we don't want to pay commissions on sales in the last month of the third quarter, because that is going to adversely affect what sales we're going to book, or not the sales we're going to book, but our net income. Okay, and then of course, evaluation. We would look at the adequacy of any allowance accounts and if the adjustments have been made, and then the presentation, of course, we would look for, in this case, amounts due from related party transactions, and then we would evaluate appropriate disclosures. Okay, obtaining the evidence, inspection of records and documents. How well is documentation kept? And if you look at this little diagram here, it's a nice little diagram. Here's our source documents, or these copies, or these originals. How is the records being kept? Okay, the evidence that we obtain from external documents is more reliable than evidence obtained from internal documents. Why? Because we assume that external entities do not have any reason not to be objective, and no collusion or independence impairment. Okay, then we have vouching, which is test occurrence, and then we have tracing, which tests the member audit trail. Okay, so this tests the completeness. So we would go from the journal back to the source document, and then the trail will take us from the document to the journal. Okay, so all this in between is how we test occurrence and completeness, hence what we call the audit trail. Okay, all right, inspection of tangible assets, physical inspection. So this would be the example we did for inventory. Okay, we would actually go out and make sure that inventory doesn't have any obsolete items or expiry type items that they are still accounting for, slow moving items that should have been moved, they changed from LIFO to FIFO, and want to understand why, those type of things. Inspection. And then observation is the process of watching the process work, okay, by the employee. So we would actually do walkthroughs to complete our observation. In conducting an inquiry, the auditor should consider the knowledge and objectivity, experience, responsibility, and qualifications of the individual to be questioned. Okay, this is the inquiry piece. Okay, so when we talk to the internal auditors, if they have an internal audit team, we would talk to them to determine their education level, how long they've been there, how long they've worked in the industry, you know, and literally get an understanding of their competence level before we actually use, you know, information from them. Okay, so we would probably have a set of determined questions. Once we understand the business ourselves, we would have a list of questions for them, and we would ask them, and then we would evaluate their answers. Okay, and external confirmations. This is information we get from the banks, we get from their vendors to confirm confirm invoices and that type of thing, and payment. Information from the banks to confirm deposits, withdrawals, etc. Information from predecessor auditors. Any information that is outside. Okay, external confirmation. Here's some examples. Cash balances from the bank, accounts receivable from customers, inventory on consignment from the consignee, of course. Accounts payable from vendors, bonds payable from financiers, common stock outstanding from the brokers, insurance coverages from the insurance company, and collateral actually from the creditors. Okay, this information that we would get back, we would actually note that we have confirmed that these items have tested correctly. Okay, relationship of the audit evidence to the audit report. Okay, we're going to start right here, okay, with the statements. In the statements are management's assertions. Okay, then we're going to apply our audit procedures to that. Okay, they're going to provide evidence. We're going to provide evidence on the fairness of the financial statements through our tests. That's why we're going to do these tests. Then once we do that, then we're going to come to some conclusion, which would be what we believe our opinion is going to be based on this information. And then of course we issue the audit report. Audit report is tied to the financials, so there's this huge circle there. Okay, so here is this evidence that we're going to do, the recalculation piece and the reperformance piece. Recalculation, we're not going to actually be out with the employees or the internal audit staff doing the recalculation. We'll get the documentation, we'll get our spreadsheet, and we will actually go from at some point in the transaction to the end point and compare what we got with what they got. Okay, so we just do a comparison there with the recalculation. And then, of course, we will actually go out, learn how to do this particular procedure or this control, and it may be a combined test, and we will actually redo it ourselves. So that is the reperformance piece. So we will inspect, we will observe, we will confirm, we will recalculate, and we will reperform. Okay. Now, here's our analytical procedures that we will do the evaluations of the financials made by a study of plausible relationships among both financial and non-financial data. The non-financial data is going to be found in the disclosure notes to explain how we got the summary information that is included in the financials. And then the scanning piece. Scanning is just we look for any items that are extraordinary items that are in the financials. Okay, reliability of types of evidence. General reliability relationship, you can find this in your book. A higher inspection of tangible, this is types of evidence. Inspection of tangible assets, reperformance, and recalculations. That would be higher on the list, on the scale, I'm sorry. And then inspection of records, documents, confirmations, analytical procedures, and scanning. And then lower would be observation and inquiry, because we haven't actually put our hands on it here. So that's going to be low. Okay, the reliability piece would be low. Higher, here we put our hands on it. We redid it. We recalculated and came up with the same. And then, of course, inspection and confirmation would be somewhere in the middle. But just the same, the inspection of the documents and confirmations are a very important part of the audit. Okay. Fill in the assurance bucket. I don't particularly agree with this diagram, but okay, so here's the bucket, and this is what they're saying. Okay, here's the evidence we're putting in the bucket, and here's our risk assessment. Here was where we test the controls. Here's the substantive analytical procedures that we'll do on the account classes, and then the remaining assurance needed from tests of details. Okay, so this is where the iffy part comes in, because I don't believe that there's any additional assurance that we need to do after we do other than the evaluation. So I'm going to say that the evaluation comes here, and I'm just going to leave it at that. Okay, this is examples of filling the assurance bucket. How we get to the point of evaluation here, and this is also in your book. Okay, audit documentation, very important. Our working papers. This is the cornerstone of what most auditors, we have to be very careful about our documentation. Okay, our principal record of the audit performed, all of the evidence that we obtained, and all the conclusions that we reached and why are in our working papers. Okay, so the two functions they serve, they provide support for our audit, okay, and they aid in the planning, performance, and supervision of the audit. Every single thing that we do is in there. So every conversation, every written communication, everything is in our working papers. Okay. Okay. The audit documentation should demonstrate how the audit how the audit complied with auditing and related professional practice standards. So we're going to do everything in accordance with GAS. And fortunately for some, the way the work papers is set up, there's a notebook, there's tabs, everything goes in its place, so it's easier to find, peer reviews are easier to do, etc. They support the basis for the auditor's conclusion. So we can go back and say, well, why did you issue us an adverse opinion, or why did you issue a unqualified opinion for this? We can go back to our working papers and we can tell them exactly what produced that opinion. And then it demonstrates underlying accounting records agreed or reconciled with the financial statements. So that would be the evidence that we collected. Okay. The audit documentation should include a written audit program. Okay, and that's what for each account balance or class of accounts, class of transactions, we will have a plan for that. Here's the assertion that we're testing, and then how we tested it or what documentation we got. Enable a knowledgeable and experienced reviewer to, number one, understand the nature, time, and extent of our audit. And number two, determine who performed and reviewed the work as well as when it was done. So that's part of the peer review that we generally will get. Okay, there's two types of files in our working papers: the permanent files and the current files. Okay, in the permanent file, we're going to have these items. In the current files, we're going to have these items. Okay, let's talk about assertions. These are the assertions about classes of transactions and events for the period under the audit: completeness, occurrence, cutoff, authorization, accuracy, and classification. We want to make sure that each transaction is complete, that it actually occurred, that it occurred within the accounting period that we're auditing, that it was properly authorized, that the calculations are accurate, and that they're under the correct classification. We do not want revenue in expenses and vice versa. Okay, those are the assertions about the classes of transactions. Okay, now I want to show you these are the assertions about presentation and disclosure, the classification and understandability. Okay, everything is classified and presented the way it's supposed to be, where it's supposed to be, on which statement it's supposed to be on. It's accurate and the valuation is correct. Liabilities are evaluated like they're supposed to be. Remember the example about taking a short-term portion of long-term debt and declaring that it's going to be refinanced and moving it back to long-term. We want to make sure that that is accurate and evaluated properly, that everything that's supposed to be there, including disclosure notes about the summary class of transaction, is complete, and that everything occurred, and that all assets and liabilities actually are the right and obligation of the company. Okay, those are management's assertions. Okay, format of the audit documentation. Okay, so we have the heading, the client name, the title of the working paper, and the client's year-end date. This is going to be on every single piece of paper in your working papers. Okay, so every document has this. Okay, indexing and cross references. These are notations that provide a trail from the financial statements to the audit document. So everything has a number. Okay, so all the revenue accounts that have a number, and then of course the tick marks. Normally, we'll have that's all those post-it notes and all the notes and stuff from the people that are actually doing the testing. Any opinions that come up, anything we got to go back and check. If something didn't work out, a calculation didn't work, they will all be here in what we call tick marks. Okay, our working paper should be organized, okay, so that we can find evidence when we're going through the evaluation of the results process. When we're communicating with management, it just makes it a lot easier. Plus, we are required to have peer review, so of course everything has to be numbered and titled so that we can go back and find what we need to find very effectively and efficiently. All documentation that we have in our working paper file is the property of the auditor, including RBCs. And number 3, the Sarbanes-Oxley Act of 2002, which we so fondly call SOX, S-O-X, requires all documentation to be retained for 7 years, so we cannot shred it. Okay, so enough of documentation. Let's talk about analytical procedures. So now we have our risk assessment. We do our substantive testing, and then our final analytical procedures. And we know what risk assessment is. We do that in the beginning to gain our understanding. Substantive testing, we grab all of our, pull our statistical sample, and then we request evidential matter to test it. And then we use an overall review of the financial information in the financial review stage of the audit. That's the evaluation piece of the audit. So it's a lot of work, but we have surmised it in these 3 areas. Okay, so Table 510, according to the slide in your book, we have our trend analysis, ratio analysis, and reasonableness analysis. Okay, and we're going to talk about these three. We're not going to do a whole lot of ratio analysis, but we are going to do some based on our business risk assessment. When we look at industry like inventory turnover ratios and liquidity ratios and sales to inventory ratios. We're going to look at accounts receivable turnover ratios just to see if they match or are similar to the industry. The business in the industry are similar. Alrighty. Okay, the expectation. Auditing standards require the auditor have an expectation whenever analytical procedures are used. An expectation can be developed by using a variety of information sources, and here's a list. The financial and operating data, which we'll get that in the very beginning, all of their budgets and forecasts for revenues, expenses, for anything that they forecast for financials, publications from their industry, how the industry is doing. We will contact and get information from any competitors, similar size and so forth, sales and that kind of thing. We would do a management analysis as well. And then any analyst reports that we have, especially if it's a public company, analyst reports will come out on a quarterly basis. And we will review that to develop our expectation of how our what analytical procedures we're going to use. Okay, and we talked about tolerable differences. Okay, so we have the tolerable differences here. So now we went out and we looked at the industry. Okay, so now we're going to compare what we expect to happen based on the industry to what we actually recalculated. And then we look and say, okay, what do these differences mean? Why is there a difference? And if it is a difference, is it within our tolerable difference? Okay, so we say, okay, there can be a 1 to 2% difference in inventory turnover ratio, and say we get a 1.2. Okay, so we're probably not going to make a big fuss about that, and there probably would be no additional investigation. But say, for instance, the inventory turnover ratio for our client is 5.2. The inventory turnover ratio for competitor company is 2.2. So there is a big difference there, and we probably will investigate the reasons why and report that to management. Okay, here's how we investigate the difference. We have the risk assessments and the procedure differences, and then we corroborate the evidence. They say this is not required, but corroborating the evidence, just making sure that we have our ducks in a row, which will probably happen anyway, although it is not required for us to do that. Then the final analytical procedures of the differences. Okay, what did we find? How did we find it? And if we do have to do additional, this is the investigation of the differences. And then, of course, how we found it. So we would actually have evidence on what our analysis results were for that. Okay. So, management assertions again. Assertions about end of period account balances. So, same deal. We have the existence, completeness, valuation and allocation, rights and obligations. Okay, because think about what our adjustments are going to look like at the end of the year. We're going to do expenses, and these are going to be under some subsidiary accounts. So we want to make sure that these transactions actually exist, that they are complete, that they've been evaluated properly, that everything that's supposed to stay stays, everything that's supposed to be adjusted out into the statements is adjusted out, and that we also have rights to the assets. Like, for instance, earned revenue, for instance, that services have been provided or a product has been delivered, etc. And remember, even with this, very importantly, especially if you are a product, your client is a product company, and they have to deliver product to a person, we have to go and make sure how it was actually shipped to the person. Otherwise, remember, freight on board, shipping point, etc., that determines who actually owns that inventory based on how it's shipped. So we would check all of that. That's part of the rights and obligations. Okay, short-term liquidity ratios, You already know about that. Activity ratios, we will talk about those. Receivables, inventory, we just said those things are. Profitability ratios. The gross profit percentage and the profit margin is what we really are looking for here. Return on assets, return on equity, we generally don't do those, but of course in that list of ratios that I gave you, these are all included there, and they're also in your book, I believe. They are actually in chapter 5, so you can look through that, and there's a list of those ratios. Okay, coverage ratios, debt to equity. Of course, we will look at debt to equity just for the simple fact. Remember the Olympus example where there was way too much equity based on the treasury stock that they repurchased, and then we look at their debt. There actually should have been a loss there, but the reason why they purchased that treasury stock back and didn't report the loss is because that would be a debt. It would be a loss, and so therefore they conceal that through taking the loss off of their liabilities, and that was part of that whole acquisition that they did. So anyway, we would look at coverage ratios, not times interest earned so much as the debt to equity. Can they really afford to have all of this debt? And for Olympus, gaining that treasury stock back actually helped their ratio. But if we did a test on on the equity account, then we would have found that they paid 3 times as much to get the treasury stock back. So that is the end of chapter 5. Remember, you can take notes on these videos and bring these notes with you to your exam. We will be testing on the information presented for chapter 5.